Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate filings with a wink and a nudge. Today we're looking at Broadridge Financial Solutions, and let me tell you, it's not exactly a wild ride, more like a slightly adjusted route on an already familiar road. So what's going on here? Well, this is an amended report, meaning they already told us something, but they had to go back and fix a small detail. Think of it like sending out a birthday card and then realizing you accidentally wrote the wrong age, or maybe just the wrong date. In this case, the adjustment is to a loan agreement they entered into. The big news here is about a new loan deal. A term credit agreement. Broadridge snagged themselves a cool $750 million. Now, this isn't pocket money for a snack, this is serious financing. They're using this money to pay off some older debt and then for what they call general corporate purposes, which usually means anything else they need cash for, like investments or operations. This filing clarifies a detail about when this new loan needs to be fully paid back. It's due 5 years from when they signed the deal, which was August 21st of 2025. It's important because it tells us about their debt schedule and how they plan to manage their finances over the next few years. It's also worth noting that they took the full $750 million right away when they signed the agreement. So they didn't get it in pieces, they got it all at once, and importantly, if they decide to pay any of this loan back early, they can't borrow that money again later. This is pretty standard for this kind of loan. Now, here's a bit of flexibility. Broadridge can pay back this loan early, either all at once or just part of it, and they won't be hit with penalties for doing so. However, there are what they call customary breakage provisions. This is a bit of financial jargon, but basically, if they pay back a loan before its time, especially if interest rates have changed, the lenders might try to recoup some expected interest income. It's like if you break a CD early, you might lose some interest. Like most big loan agreements, this one comes with rules. These are called covenants, and they're basically promises the company makes to the lenders. There are affirmative covenants, which are things they must not do. These are designed to make sure the company stays in good financial shape so it can repay the loan. These negative covenants are pretty standard for corporate loans. They'll have limits on how much debt their other companies called subsidiaries can take on. They'll also have restrictions on selling off assets and then leasing them back, which can be a way to get cash but can also signal financial trouble. There are also rules about who they can do business with, especially if it's with people or companies that are already connected to Broadridge, like big executives or major shareholders, and really big moves like selling the whole company or merging with another one will likely be off limits without the lenders say so. A super important rule here is about their leverage ratio. This is a measure of how much debt a company has compared to its earnings. If Broadridge's debt gets too high relative to its profits, they could be in violation of the agreement. This is a key indicator of financial health, and lenders keep a close eye on it. What happens if Broadridge breaks these rules? Well, if they miss a payment, violate a covenant, if there's a major change in who owns or controls the company, or if they default on other significant debts, the lenders can force them to pay back the entire $750 million loan immediately. That's a big stick they're holding. Think of it like if you miss too many mortgage payments. The bank can demand the whole loan back right away, escrow upon certain insolvency and bankruptcy events of default. The loan shall automatically accelerate, and all of the outstanding commitments under the term credit agreement shall be automatically cancelled. Streams chain, and if things get really bad, like if Broadridge ends up in bankruptcy or insolvency, the loan is automatically due and payable, and any unused parts of the loan facility disappear. It's automatic protection for the lenders if the company's financial situation collapses. Let's talk about the cost of this loan. The interest. It's based on something called term SOFR, which is a benchmark interest rate plus an extra percentage. Right now, it's 1.250% on top of that, but this isn't set in stone. The interest rate can go up or down, meaning an increase or decrease, depending on Broadridge's credit rating. If their rating gets better, the interest rate might drop, making the loan cheaper. If their rating drops, the interest rate will likely go up, making it more expensive. This is a common way for lenders to manage risk. This whole description is just a summary. For all the nitty-gritty details, you'd need to read the full agreement, which they've attached as an exhibit. It's like reading the movie trailer versus watching the actual movie. Now, let's quickly look at how Broadridge's stock is doing. Their common stock is traded on the New York Stock Exchange under the ticker symbol BR. This is the main way people invest in the company. They also mention their headquarters address and phone number, but honestly, for us deciphering the financial story, that's not the most interesting part. We're more focused on the money and the strategy. Looking at this filing, it's clear that Broadridge is actively managing its debt and financing. They're refinancing older debt with new, potentially more favorable terms, and this new $750 million loan is a significant move. The fact that the interest rate can adjust based on their credit rating shows they're aiming to maintain a strong financial profile, which is good for investors. However, like any company with substantial debt, they need to keep a close eye on those financial covenants, especially the leverage ratio. If their business performance falters, those covenants could become challenging obstacles. They seem to be making smart moves to manage their capital, but the underlying performance of their business will ultimately determine how easily they can navigate these loan agreements. It's a sign of a company that's grown and matured, needing larger credit facilities to support its operations and future plans. The key takeaway is that they're replacing older debt, likely to get better interest rates or terms, which is generally a positive financial management tactic. Alright, that's our breakdown of Broadridge's amended filing. What's your take on this new loan deal and what it signals for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and don't forget to subscribe for more deep dives into corporate finance. And hey, if you want to chat with us and other finance enthusiasts, check out the Discord community link in the description. Thanks for watching. See you next time.